Hi guys, welcome to the second video of the financial model discussion. So this is a very crucial for the investment banking job, and you need a strong financial modeling skill to get into the finance job or investment banking job or any job related to data analytics as well. So in this video we are going to discuss about the different schedules. In the last video we discussed about the revenue and the costing of the company. Let's say it's a revenue segments of the particular company. So it's first one, there's rental services, then there's a business services, advertisement, and others. In this video, there's a costing as well, like sales cost. So first one is a direct cost. So video programming cost as a percentage of sales, employees as a percentage of sales, high speed data as a percentage of sales, voice as a percentage of sales, and video franchises and other fees, and the other direct operating expense as a percentage of sales. Then we have the indirect cost is the selling and general administration expense as a percentage of sales, and merger related restructuring cost as a percentage of sales. So this one is that. If we go into the different things if you go into the ratio analysis, let's say these are the different kind of the ratio for the particular company. It's a current ratio, quick ratio, and the cash ratio. Then we have the receivable turnover ratio and the inventory turnover ratio, and the different kind of ratio. Let's say we go into the now we go into different schedules of the company. Let's say it's a working capital management schedule. So as we know that a working capital is simple, the assets minus liability, current assets minus current liability. So this is a working capital balances. So current investments are also there in the asset side. It's the current assets. Then we have the trade receivables, deferred income tax assets, and the other current assets. Then we have the another, it's current liabilities, account payables, accrued programming expense, deferred revenue, and the other current liabilities. So these are the current liabilities for the vertical company. And then we have the net working capital. It's current assets minus current liability. So it's a net working capital for the particular company. If we get the increase or decrease in the particular company, so let me introduce that there's a different method for that. Let's say net increase or decrease in the particular expense. So this is defined on the basis of this, and we have the ratio and the assumptions. Let's say current investments and the trade receivables percentage, and the deferred tax, income tax, etc. Other current assets is a 1% or the 1.5% of the company. Then the account payables is a 21% 0.7, that's 18.5%. Accrued programming expense 9% to 7.5%. Deferred revenue is 2%, and the other current liabilities is 19% to 18%. Then we have the depreciation schedule for the particular company. Let's say there's a net sales is also there. Then we have the capital expense, the type of the expenses we generally incurred this year for the capital purpose. Let's say these are the total kind of the expense we generally put out in the bucket for the as a capital expenses or for the working progress expenses for the development of the any assets or liabilities of the that company. So it's a percentage of net sales. It's a 14%, 13%, 16% of the particular company. Then we have the beginning net PPE. It's a 15.056%. Then we have the capital expenditure for that. It's a 36.85%. So this is the capital expenditure. This is the addition in the beginning PPE. Then we have the depreciation expense. We will deduct them from the depreciation and net PPE. And then we have the ending PPE. So it's a beginning PPE plus capital expenditure minus depreciation expense. So it's ending PPE. So it's a PPE breakup. Let's say land and building, distribution system, converters and modems, and the capitalization software and vehicle and other investment cost. So this is the total amount of PPE, and then we proportion of the assets on the basis of different items. So we generally follow the straight line method for the calculations of the depreciation for these items. And then if we go into the total capex, like this one is a total capex and this is a breakup one. And then we have the land building and improvement, distribution systems, converters and models, capitalization software cost, vehicles and other equipment, and construction progress. So these are the total breakup for a particular company. Then if we go to the land and building improvement, so its useful life is 17.38, land and building is 1678.00. Then depreciation expense, it's a 9655. So it's a depend on the number of years. Then we have the depreciation expense for the particular company for the particular year. Let's say this is the total expense of the this, and then we have the depreciation expense for the 2015, 2016, 17, 18. So this is on the basis of different method. Let's say we calculate the year on year on the basis of total depreciation expense. So this is the number. In the first year we generally take the by 2 because we are assuming that we are taking this in the middle of year. That's why we are taking this as a 2. So these are the calculation of that, and this is the total expenses. So this is for the second part of the video. In the next video we discuss about the different schedules and the valuation and income statement of the company. So how to drive that and how to make the valuation of the income statement of the company and the basis of different valuation methods. So let's meet in the next video for the better update.